To reinstate investor confidence in his company, Gautam Adani had prepaid loans worth $1.11 billion on February 6th to release pledged shares in his three key companies: Adani Green Energy, Adani Ports, and Adani Transmission. Market analysts said that the move released some pressure from the group's share prices in case they were to fall further because there will not be any top-up demand from the lenders. To understand that better, let's first know more about share pledge. In simple terms, share pledge means borrowing funds in lien of shares as collateral. This is done by both investors and promoters of the company. Just like individuals use house or gold as collateral, equity shares too can be pledged with the bank for availing a loan. Investors, even though they hold an asset in the form of shares, their funds are locked and cannot be used for new trades. Hence, they can pledge shares with the broker and avail margin for trading. In the case of promoters, other than raising funds by way of issuing fresh equity or debt, they can pledge existing shares and raise funds immediately. Promoters can possibly pledge shares to meet working capital requirements, funding other ventures, or fulfill debt obligations. For instance, the Adani Group was to pay part debt worth 4,165 crore rupees from its planned 20,000 crore rupees FPO. But here comes the tricky part. Once shares are pledged, they act as a lien and it gives the lender the right to recover dues in case of a default. The default could be on two counts. One, the inability of the promoters to pay dues on time, or two, significant value erosion in the share prices, thus indirectly impacting the pledge against the loan value. For example, say a promoter pledged shares worth 100 crore rupees for 90 crore rupees loan. In case the share valuation dropped below the outstanding amount during its tenure, the loan becomes a risky proposition for the lender. So in such case, the lender can ask the borrower to increase the lien by way of pledging additional shares or alternatively offload some percentage of the pledged shares in the open market to recover dues. In case pledged shares are offloaded in the open market, it eventually results in decrease in promoter holding and additional free float in the market. Also, companies with high pledging tend to exhibit higher volatility. Hence, investors must keep a close watch on promoters' holdings.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.